Dryden Pence is with us, Chief Investment Officer at Pence Capital Management. Great to see you.
Great to see you.
What a week it was. You know, when you think about the action, I mean, what did you make of the action?
Well, I think, you know, people finally realize those big questions are off the table. We now know who the president's going to be. We now know what the Senate's going to do. So clearly, we're not going to have tax increases, and we're probably going to have tax cuts. So when you take that backdrop, everything moves forward to something that's going to look like it's going to help earnings going forward. Record earnings probably looking forward next year, and that means you're probably going to continue to see a record stock market.
There are folks who are very worried about next year. I mean, record earnings, you were telling me some good numbers, somewhat astronomical maybe, right? Well,
when you think about the fact that we're probably in an administration with less regulation, we're probably in a situation with lower interest rates. We're probably having a stimulative government, and we've got probably more buybacks now. All of those things build into the market doing well. And then companies, you know, this last year we had record earnings for most companies. 75% of them are beating earnings expectations. So we look at probably a 13-14% increase in earnings next year. 13% increase in earnings probably means a double-digit market.
It's amazing. So how do you position after a week like this one where we saw records? I mean, the Nasdaq's up over 5%, the S&P's up over 4%. If you had been in cash on the sidelines because you were worried, you missed it. Now we had a great run this week. What do you tell folks what to do between now and the end of the year?
Well, you know, we had a great run. A lot of it was led by the Magnificent Seven and those things. But what we're seeing is, you know, the rest of the S&P 500, the rest of the Nasdaq are coming out of an earnings recession. They're now doing that now. So you're going to look at strong earnings in third quarter, fourth quarter. So I would spread out my exposure across the rest of, like the 493 on the S&P 500, and then I would look to small caps.
Right.
Because so small caps are going to begin, people that make stuff, people that are in the industrial areas, but that's where the earnings are going to come in, and small caps are going to do better in this market. That's what we think we do. So spread it out, move it down in the capitalization stack.
So, you know, small caps is an interesting one. I mean, there were a lot of folks who were waiting for the Russell to participate. And sometimes when you see stocks up, you know, a half of 1%, it's the Russell that's up 3%. But sometimes on the downside, it takes the bigger leg down, too. So it is a little volatile sometimes. But what percentage of a portfolio should be in small caps now? And you'll have a lower rate environment, right?
Right. We'll have a lower, as interest rates move down, that's going to increase margins. So we see it moving, you know, from 7 to 10% of a portfolio, probably up another 5%. So you could see it maybe almost as much as 15% of a portfolio into small caps or mid caps. And then you have these companies, as the market moves, they move from small cap to mid cap on their own. So you got to, you've got the blurred line there. But moving, you know, sometimes you have like 5 or 6%, but now I think that allocation in 2025, our allocation is going to move more to 10 to 15.
The moves this week lifted the Mag 7 to over 17 trillion in value. I mean, obviously there was historic trading. You have one of the names here, Amazon, as a name you like.
Exactly.
Tell us where you think this could be headed and why. What will be the catalyst for Amazon?
The catalyst for Amazon is almost all of the above. And what I mean by that is we're going to have a good Christmas. You know, it's been a good year. It's going to have a good Christmas. When you take a look at four out of every $10 spent on online shopping, and online shopping is continuing to grow, all go through Amazon. So this is a dominant platform. It's a dominant place. So the catalyst for continued, in addition to all the AWS and all the AI, but the catalyst for this point is going to be a strong Christmas, and Amazon's going to get a large percentage of that.
Yeah, look, it's trading around 208 today. Where do you think this stock? I saw Daiwa Securities has Amazon's price target now at 230 and a buy rating. That was today, this morning. So they see upside from 208 to 230. Does that sound like a good place to go there? I
would think that that's a reasonable pricing. We usually don't publish exact price targets, but I think that you're looking at continued growth in Amazon, and I think that we're certainly constructive on it going forward. And rather than pick a specific price, you know, it depends on how long you're going to hold it.
Right, and the trends and the news flow and all that. Right. ASML, a name that really was so exciting for a while, and then in June really got hit hard. The earnings took it down. It was over $1,100, and now today it's $668. Tell me about ASML.
Well, I've said frequently, you buy chips on dips. and things that are related to that. ASML is so absolutely essential to the AI growth and all the chip growth. I mean, ASML is what 40% of the capital expenditures of NVIDIA, TSMC, right? So you're taking a look at all of these chip companies. They have to have these extreme ultraviolet light machines. What took ASML down was their legacy stuff, but their new stuff is really going forward and growing, and they are the choke point. You can't create more chips without buying ASML stuff, not the expensive high capacity.
Meanwhile, we're talking about this, and so I just plugged it in, and I see a report from Bloomberg talking about an outage, a global outage, for an IT outage for ASML. Bloomberg citing a company spokesperson that this disruption started Friday morning. So the stock is down about 1.3% now. They're investigating the cause of the outage, but you don't want to hear that. I mean, it's a skip. I mean, that's what we heard for CrowdStrike. We started to get nervous. I'm not making the comparison, but you don't want to see an IT outage.
Exactly. But all of these things I see as transitory. The big picture is AI has demand for chips.
Yeah.
And their machines are absolutely essential. So you open, you step back. And the
company has said now that it has been resolved. So that's good news there. But I guess it was a big deal, worth reporting. How about when we look at URI, United Rentals, your thoughts here? It's a winner today.
The big theme is that roads and bridges in this country have deteriorated tremendously. We've not spent what we need to. So now we've got to replace all the roads and bridges. We've got $500 billion already allocated to doing that. We need about $1.2 trillion. And most of the companies that do that rent from URI. It's a fragmented business, but they're dominant about 15% of it. And so when you have, we're building a lot of roads and bridges. That means there's a high demand signal for what URI does. We think it's going to be accretive. They're only selling about 17 times earnings, so we've got some earnings multiple expansion there. So we're very constructive on that company going forward. It's in the right space for just the basic infrastructure build out of this country.
Making some good moves already, because we're seeing it at new highs this week. I mean, on the 6th, the day after the election, it hit 888. Today it's at 879. So it's having a great week. I mean, this week it's up 11%, folks. So, when you think about manufacturing or industrials or energy for 2025, do you have certain sectors that you think may do better than others?
I mean, we certainly continue to like AI, but we certainly like industrial manufacturing and consumer discretionary and staples. But I think that the manufacturing side of it is very important, because don't underestimate the fact that interest rates will be going down. Not necessarily as fast as everybody thinks so, but when you do that, that increases the margins of these manufacturing companies. And you're going to see, there is talk about the tariff trade and things like that. That's more onshoring of jobs and things in this country. So I've often said, when you get into these environments, you look for manufacturing companies, folks that make stuff that are located between the Appalachians and the Rocky Mountains, because they have usually lower labor costs and better ability to expand. And
to your point, when you were talking about AI and that trade, Amazon reportedly is in talks for another Anthropic investment. Anthropic has become, a real AI household name at this point. So what's the final here? I mean, you sound generally pretty bullish.
Yes.
The Fed, you think, will keep cutting, or a pause in December? I mean, I guess one pause or move doesn't matter, but big picture?
Well, big picture, I think we see one more cut this year.
Yeah.
And then next year, it's really all about the cadence. And so they're going to do 25 basis point cuts is what we believe. And you probably are going to see one a quarter. But they're going to become very data dependent. I think they'll try to step away from all the noise and say, all right, we've moved into this. Now the big question is going to be, what is neutral? Is neutral 3? Is neutral 3.5? They want to move into, I think they stuck the landing. I think that they've done that very, very well. And the question is now, how do we get to neutral? And when do we do that? And probably the back half of 2025, right near the end, going into 2026, they'll say, this is where neutral is. And they will have gotten us there. And we'll have a very robust moving economy.
Yeah, Dryden Pence, great to see you. Dryden Pence of Pence Capital Management. Thank you.
Thank you.